Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday the 13th of February 2020. And yesterday we produced a video entitled EU Industrial Production and Euro Weakness Impact on Silver Prices. And on Monday, Euro falls again as dollar, equities and gold and silver rise, where we highlighted that the Eurozone was experiencing production difficulties and that the euro itself had hit its lowest level for over 4 years and could indeed head lower. During our gold and silver weekly update published on Saturday, we pointed out that Jerome Powell would be giving testimony to both houses of Congress this week, Tuesday and yesterday in fact, and it is about this testimony that we are reporting today. Now on Tuesday, Powell was entering Capitol Hill during a sensitive time. The world, it was and is currently in fear of the coronavirus, with increasing deaths and infections each day. The impeachment trial had not long been completed, with Republicans in high spirits and Democrats deflated and angry, and the central bank having to deal with what it perceives as the problems surrounding too low an inflation rate, while at the same time ensuring there is adequate liquidity in the banking system as a whole and the repo market in particular. So Jerome Powell was speaking to the House of Representatives on Tuesday and the Senate on Wednesday. Now Powell had to be fully aware that he must generally provide an upbeat presentation, though acknowledging the coronavirus issue and its threat. Also be slightly dovish to appease equity markets, while at the same time ensure the Fed has sufficient armoury to deal with a recession, should it occur, via lower interest rates and alternative versions of QE, but being mindful not to go down that track too soon in fear of having no ammunition left with which to commence the economic battles. Now, as a reminder to our listeners, we pointed out that in December and again in January, the Fed indicated that there would be no rate cut in 2020, or rise for that matter. And we've stated that we do actually expect one cut later this year. However, the market seemed to accept that no cut is acceptable, which is why we are seeing yet again all-time highs being reached on the various US indexes. So markets were expecting a continuation of that policy to create a degree of stability in a rising equity trend, with the coronavirus being really the only major impediment to that continued optimism. Now, in fact, prior to this week's testimonies, Paul Ashworth, chief US economist at Capital Economics, told CNBC about the Fed's desire for an average 2% inflation rate. We'll quote him. He says, "We think that he, Jerome Powell, will indicate a dovish shift in tone within the Fed, particularly in light of the review they're conducting at the moment on the possibility that they could adjust the framework, build up an average inflation target, something like that. I just wonder whether there will be any hints of the general need to allow, after a period of prolonged undershoot, an occasion for allowing an overshoot." Unquote. You see, it comes as no surprise that whether one agrees with them or not, Fed officials see 2% as a healthy level in a growing economy, and one that allows enough room for interest rates to be able to be cut in case of an economic downturn. Now, at the January meeting, the committee tweaked its policy statement to emphasize its desire to get to 2% rather than near it. So they're clearly targeting 2%, and from what's being suggested, could even allow for inflation to go above 2% for a short time, as long as the average is 2. Now, we have already reported this week the concerns within Europe, and we will know tomorrow some rather important economic data about Germany and its economy, and whether it is to be tilted into recession or not. Now, during his opening statement before the House Financial Services Committee, Fed Reserve Chair Jerome Powell defended the central bank's decision in December 2019 to leave interest rates unchanged, and pointed to a number of positive indicators, including continued job growth, low inflation, consumer spending, housing investment and wages, saying, quote, As long as information about the economy remains broadly consistent with this outlook, the current stance of monetary policy will likely remain appropriate." Unquote. He also encouraged Congress to address the high and rising national debt while the economy is strong. Frankly, we will be surprised if the government will do that in an election year. He also added that, quote, "The Federal Reserve is closely monitoring the coronavirus, its impact on China, and the effect that it could have on global economic growth." Unquote. He also expressed some misgivings about rates being so low, not only with his own Fed, but in other central banks around the world. And with the Eurozone potentially lowering rates again and soon, if the economic data proves as poor as many may suspect, this will place even greater pressure on what is already an extremely high-value dollar. Peter Schiff, Mike Maloney, David Morgan, take note. We have a dollar index of 99 as we speak. Some imminent collapse, gentlemen. Now this is the important, or one of two important comments Powell made. Quote, "This low interest rate environment may limit the ability of central banks to reduce policy interest rates enough to support the economy during a downturn." Unquote. And he is, of course, right. If he does or did what President Trump wanted and still wants him to do, and reduce rates to zero, what does he then do when the economy does eventually fall back? Which inevitably, one day it will. These are calculations that the Fed has to make, because the alternative would be swinging tax cuts that the government would have to make to boost the economy. But then its receipts would be far lower than its expenditure, which means the government has to borrow more, the interest of which, quite frankly, technically at least, it will be unable to pay without printing even more money and increasing the national debt even further. Now, broadly, Powell reiterated what he has already said, both in December and again in his statement in January. The rise of the coronavirus is the major threat, while other threats such as US-China trade dispute and Brexit have waned somewhat, and even Iran is currently quiet for the moment. So the main headline from his testimony, and which gained some media attention, was, quote, "The central bank may not have the firepower to fight the next recession," and called on Congress to get ready to help by way of fiscal policy. Unquote. And with rates so close to zero, one does not need to be an economist to realize this. Now finally, Powell also made it clear that the central bank would use various versions of QE if necessary, should a recession become apparent. The obvious course being the purchasing of Treasury bonds to drive down long-term interest rates and forward guidance on the future direction of short-term rates. However, he seemed to rule out the now adopted practice in Europe, sub-zero interest rates. Now, interestingly, an article in Bloomberg this morning suggests that, quote, "The US government's sale of 30-year bonds Thursday is likely to draw a record low yield near 2% after the Treasury rally spurred by the spread of the Wuhan coronavirus in China and around the world helped drive rates across the curve to multi-month lows." Unquote. Now, trading of Treasury securities leading into the auction suggests that the new debt will yield around 2.08%, just above that 2% figure. That's below the all-time low of 2.17% for a 30-year sale that was achieved in October. Now, these bond sales happen every month, and they are actually well worth observing and placing on one's radar. Now, meanwhile, at the time of writing, which is 1840 GMT, the Dow is down some 88 points, but is still well above the 29,000 level at 29,462. Now, gold has spiked a little today to 1575 from an earlier low of 1561. And silver too has risen, but still cannot match its opening on Monday, and is trading at $17.64 from an earlier low yesterday of $17.46. Nevertheless, achieving now the gold to silver ratio we predicted many, many weeks ago of 90-1, of which, frankly, we are particularly proud, bearing in mind that almost everyone else in this space were predicting sub 80, 70, 60, and do not be surprised to see sub 50 gold to silver ratios. And even Mike Maloney, who now seems to be producing or taking part in a video every day, exalting the absolute need to buy silver before that magic 15-1 ratio is achieved. Our advice at this moment, do not be surprised even to see it go above 90. This evening, we are publishing our 2020 silver forecast in the Inner Sanctum at 11 p.m. GMT. And meanwhile, do watch out for further coronavirus news. And Greg and I will be updating listeners to our Richard and Greg channel on that very subject tomorrow. Now, finally, please do not forget that we have published already our gold forecast for 2020. In fact, we did it on Sunday, and we provided a link to this and the other videos that we've mentioned earlier in the description box below. Thank you so much for listening. If you haven't already done so, please subscribe to our channel, press the bell sign so you're notified of videos as and when they're published, and please take notice of various links that we have placed both in the description box and in the comment box, which may prove of interest to you. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.